A system that should not work, but did. For more than 20 years, Bernie Madoff operated what appeared to be the perfect investment fund, delivering steady returns of around 10 to 12% per year, consistently, without major fluctuations, without sudden losses, and without the kind of volatility that normally defines financial markets. In periods where the global economy was collapsing, where investors were losing billions, where entire institutions were failing, his clients kept receiving the same reassuring reports, showing steady gains as if their money was completely disconnected from reality. And that should have been the first red flag. Because in finance, consistency at that level is not a sign of safety. It is often a sign that something is wrong. Bernie Madoff was not an outsider trying to exploit the system from the outside. He was deeply embedded within it. He had spent decades building his reputation on Wall Street, contributing to the development of electronic trading, running a respected firm, and eventually becoming chairman of NASDAQ, which positioned him as one of the most credible figures in the financial world. And in that environment, credibility becomes a form of protection, because people stop asking questions when they believe they already know the answer. His clients were not inexperienced investors making emotional decisions. They were sophisticated players, hedge funds, private banks, wealthy families, billionaires, foundations, and major institutions, including universities and charitable organizations, many of which would later lose hundreds of millions of dollars almost overnight. In total, more than 50,000 investors were connected to his system, either directly or indirectly. And despite that scale, one essential question remained unanswered for years. What was actually happening to the money? Officially, Madoff explained that he used a strategy known as split strike conversion, a method involving the purchase of large-cap stocks combined with options to hedge risk and generate stable returns. It sounded reasonable, it sounded professional, it sounded safe. But when analysts attempted to replicate his results using that same strategy, they encountered a serious problem. They could not, no matter how they adjusted the variables, no matter how they recreated market conditions, the results never aligned with what Madoff was reporting. His performance was too consistent, too controlled, too perfect. And in finance, perfection is rarely natural. One individual recognized this early. His name was Harry Markopolos, a financial analyst who, in 1999, was asked to reverse engineer Madoff's returns. What he discovered did not take months, it took minutes. He quickly realized that the numbers did not just seem unlikely, they were mathematically impossible. He later explained that there were only two logical explanations. Either Bernie Madoff was the most talented investor in financial history, or he was operating a massive fraud. And Markopolos was convinced it was the second. Over the following years, he built a detailed case supported by mathematical models, statistical analysis, and comparisons with real market data. He sent multiple reports to the SEC, clearly outlining why Madoff's operation could not be legitimate. At one point, he explicitly stated that the world's largest hedge fund was a fraud. But nothing changed. And this is where the story becomes more unsettling. Because the issue was not invisible. It was identified, it was documented, it was explained, but it was ignored. The SEC opened investigations, questioned Madoff, reviewed selected documents, but never conducted a deep and thorough verification of the entire system. Why? Because Madoff was trusted, because he was respected, because he belonged to the system they were supposed to regulate. Meanwhile, his operation continued to grow. But Madoff was not selling performance. He was selling access. You could not simply walk in and invest. You needed to be introduced, recommended, accepted. This created the impression that his fund was exclusive, reserved for a select group. And that perception triggered a powerful psychological response. The harder it is to access something, the more valuable it appears. Some investors even claimed they had initially been refused. Whether this was intentional or not, the effect was the same. It increased demand. At the same time, another layer made the system even more difficult to detect. Madoff did not simply fabricate numbers. He reconstructed reality. He would observe real market movements, identify stocks that had performed well, and then create records showing that these trades had been executed at the optimal moments. This gave the impression of precision, consistency, control. And because these records were based on real data, they appeared credible, even under scrutiny. Behind the scenes, however, there was no complex system, no advanced trading infrastructure, no secret algorithm, just a simple mechanism. New money was used to pay existing investors, as long as new funds kept entering the system, and as long as withdrawals remained manageable, everything appeared stable. At its peak, Madoff claimed to manage approximately $65 billion, a figure larger than the GDP of some countries. In reality, the actual losses were estimated at around $17 billion. The rest existed only on paper. The entire system depended on one fragile element: trust. As long as investors believed in the system, it functioned. But the moment that belief was tested, everything began to collapse. And that moment arrived in 2008. The global financial crisis triggered widespread panic. Markets declined rapidly, banks began to fail, confidence disappeared. Investors who had previously been content to leave their money untouched suddenly wanted liquidity. They wanted access to their funds. Immediately, withdrawal requests surged. Billions of dollars were requested within a short period, more than $7 billion. And at that point, the system could no longer sustain itself, because the money was not there. It had never been there. On December 10th, 2008, Madoff confessed to his sons, admitting that the entire operation was based on a lie. The following day, he was arrested. What shocked investigators was not only the scale of the fraud, but its simplicity. There was no sophisticated structure, no advanced technology, just a lie, maintained over decades, supported by reputation and reinforced by trust. And perhaps the most disturbing part is that this system did not survive because it was brilliant. It survived because of human behavior. When something works in our favor, we tend to stop questioning it. This was not a scam built on complexity. It was built on credibility, a respected figure, consistent results, powerful connections, everything aligned to prevent doubt. And that is what makes this story dangerous. Because nothing was truly hidden. Everything was visible, but it was accepted. You should never rely solely on what someone chooses to show you, because image, reputation, and status can be carefully constructed to create an illusion that feels more real than reality itself. What you see is rarely the full truth. And the more perfect something appears, the more it should be questioned, because behind the most reassuring appearances are often the most carefully constructed lies. It was Elias Crow,